I'm excited today to present our continuation of really our third year of partnership with Hampton Manors and capitalizing on their great success and our investments in a blended fund of senior living, which is premier assisted living and memory care facilities. Going to go through the typical investment. It's going to be kind of a light deck. I want to really get into the Q&A as soon as we can, but we're going to talk about senior living, investment team, the investment, capital stack, and show some pictures of the facilities or the communities. Typical disclaimers. Let us know if you want to share it. Happy to do so. Sorry, my son is like, close it. So hi, again, my name is Anh Thanh, CEO, founder of Tozi Capital. We have $300 million of assets under management. A lot have been crypto recently, but for those who have invested with us since the beginning, we have a lot of multifamily and a tremendous amount of senior living investments. It's an asset class I really like, and I see a very long-term future in for the next 10 to 20 years. There's going to be a chronic shortage of senior living communities. And I'm very proud to partner with Shahid on this investment. Shahid is the CEO of Build Senior Living. He just had a baby this morning and could not join us today. But he has a lot of properties under management and a lot of properties in Michigan, where one of these properties is located. He actually lives in Michigan. Me and Ryan visited there a few months ago to attend one of their grand openings. We were able to speak in front of the local community. So it was great to see the community. And jointly, we have 6 constructions under going up. Some of them are very close to completion, and very excited to start operating and leasing those up soon. So why senior living? Well, I think all of us have heard about the silver tsunami and the graying of America. And this is a demographic shift that's going to be relentless over the next century. In the next few decades, there has been a chronic underdevelopment of senior living. And I think this was 4 years ago was a little bit reversed, where there was a bit of an oversupply, but due to COVID, there has been a lot less developments, a lot less constructions in senior living. And I think right now we're seeing a lot of our developments really have really strong appeal. With first, it's great that it's Class A assisted living. It caters to the community, and the community is really looking and seeking these communities so that we can have a great home for our seniors, what I believe is the greatest generation.
And in most cases, when I talked to Shahid, he said these cities are reaching out to him and asking him to build there.
Yeah. That's how we really put these projects together. And the one thing I really like about the projects with Shahid is that he's a very scrappy person. So that means that all of our facilities, all of our communities are in very close proximity to other communities, which allows us to have great economies of scale, having one regional director manage 3 communities and one potentially activities manager running 2. So sharing resources is paramount for minimizing costs. But within senior living, what I like about it is that there's a lot higher income potential. What this means is that we can charge typically 4x the average rent for the same multifamily potential unit with only 3x expense rate. And for Shahid, he runs very light on expenses. Ryan, you were there when we were picking out glasses in China. Like he was very proud of his $2 purchase of those cups. He's got that 75% discount. That's great. We actually went to a furniture store that day as well. It's also for this investment, because these are newly built assisted living, we expect much lower upkeep costs over time. So very predictable costs and maintenance for these investments. So we're building for one of the projects, St. Peter's, we're building a Class A facility. And in Commerce, the other investment, that was recently built last year, and it's leasing up now. And so these senior living also presents a really great opportunity to have cash flow stability, because once a senior or resident comes in, they typically stay for 28 months. That's sort of the average stay, and then that's really their last place that they'll stay. And so we do typically have a very solid financial check for any resident that comes in, where we make sure that they have enough finances to cover for the next 3 years. And so that's how we ensure that we provide them the best care, but also that we have very low turnover. And so this demand in senior living, especially around assisted living and memory care, and these potential communities it will continue to grow as the communities age over time.
And if I can jump in there with a question from an anonymous attendee, I'm very shy tonight. Why does Michigan have so much need for senior living?
So if you think about senior living, we typically think about why, like Florida, Arizona, sunny spots, right? And I think that makes sense. We're actually building in Florida. We have some Florida communities, but it's very competitive in Florida. And ultimately, when we build something in a place like Commerce, Michigan, Florida seniors actually fly back and come home. And that's the operative word, home. Because we're building homes for them. These are really, they want to be near family. They want to be near where they grew up. And their family isn't in Florida. Their family isn't in Phoenix or Arizona. The family is where they grew up. And they're really, they want to be near the family. And it's as much of a family decision where they go and end up versus just a senior's decision. And so these communities, not existing before, do present an opportunity now, because people have been building, we are building in Florida. But once they hear that we're building a very similar quality product in Michigan, in rural Michigan, townships really, then they will fly back, and the demand is pretty high there. So I think it's a little bit no secret that you want to be in these really small communities, because we're not building that many units. We're not building a massive community facility. We're building typically less than 100 unit facility, and we fill up pretty fast.
And to add on to that, we'll also have the viability reports uploaded to the platform, so you can read 70 pages about why Commerce is a good market for it.
Yes, there's feasibility reports so we're not going to go through too much on the market dynamics of each community. Really want to highlight why senior living and why invest in these and then the investment itself. So the investment is our 11th investment in assisted living partnership with Hampton Manors. It's the 11th and 12th property, and it's the senior living blended fund combines two of our favorite types of investments, which is a income producing investment and a quick growth investment, with three potential options for investors to choose: income, blended, and growth shares for a brief 3-year term. And these will be in the two communities. And this is for phase 1. We have yet to announce phase 2 or phase 3, but the intention is that this fund will incorporate more investments over time. Some will be the construction projects that we've already constructed or we are constructing now, and we'll incorporate that into an income portion of this fund as we acquire them from ourselves. So just to reiterate, there's two locations here, Michigan and Missouri. And the interesting thing here is that we had a income fund last year. It was very successful. We were paying investors 1% a month for that, and that is located in Michigan as well, very close to where Commerce is. And we also had a Missouri Growth Fund, which we're incorporating in, which we had two communities, Wentzville and O'Fallon, which are progressing very nicely. In fact, they started before St. Peter's, but St. Peter's is sort of the third one that we started. And so these two communities will be incorporated into this fund as private equity investment.
And Anand has a good question about the Michigan cash flow property. Is that from one of our previous growth deals or another deal? And if yes, what was the exit percent, current occupancy?
Yeah, so the exit percent for the investors in the Commerce deal, and I want to sort of step back a little bit. One of the things that when I first met Shahid and I found Shahid, the story with our investment is he was starting to sell his properties, or have been selling his properties to REITs. And then he was doing a sale leaseback, essentially where he was leasing back and managing it at a 7.5 cap. This was very attractive to REITs, and they, but ultimately what Shahid wanted was control over these properties. So I proposed to him that we will be your REIT, we will be your capital partners, and I want him to have, and for us to manage his accounting, finances, and capitalization. And he does what he does best, which is develop and operate fantastic assisted living and memory care communities. And so he's been building this over time. Commerce was not one of our original construction projects, although we have a few in Florida, and a few in Missouri, and a few and one in Virginia. Commerce was another community that he owns 19% of right now, and his partner is essentially being redeemed out or bought out through this investment in Commerce. And so he already very familiar with it. He designed it, he built it, and that partner is getting a very favorable exit, similar to our previous growth funds, which he's then tenderly changing into probably one of Shahid's other properties, I believe. It's a little merry-go-round to be very tax favorable for investors. And I want to highlight sort of for those who haven't been part of our journey with these type of fixed income, predictable investments. I really want to highlight two things that might be a little different than most other real estate investments. One is that there are zero fees. And what I mean by that is we're not charging an acquisition fee or a management fee. Investors get paid first. So, which is, for other multifamily deals, we do have those typical stuff because obviously there's a lot of work to get into acquisition. But in this case, Shahid really wants to pay the investors first. They get priority right after paying the bank. And the way that we think about this investment, or Shahid thinks about this investment, is we're essentially an extra debt that allows them to grow faster. And he pays us on time every month and never miss a payment. And that allows us to have a priority on the investment, regardless of how the community is actually performing. So that he actually doesn't charge any property management fees, which is typically 5 to 6%, or any asset management fees, or we don't charge any asset management fees. It's also a pref equity investment, and the way I like to define pref equity is like sort of like mezzanine debt, but it has sort of the same type of downside protection as debt. It sits above the senior debt capital stack, but it has the same return qualities and depreciation benefits as equity. This is also a short-term investment, 3 years, 36 months, and because these two are very new construction projects, essentially St. Peter's will be up probably by next year, and Commerce has been built last year. We expect very little capital investments for maintenance going forward. And these are very strong locations based on our feasibility study. And you're welcome to visit our online portal to see that it's open right now.
And while we're on that last slide, you talk to, here's a good question. Has COVID impacted the average life expectancy enough for the demand to be less than previously expected?
There's been two major factors of COVID during our operations of senior living. One is there has been sort of a more abundant stay-at-home, taking care of children population. And I think children population probably mean like 40, 50 years old, where a lot of these children of these seniors are actually staying at home and they're taking care of the seniors. So while we had for the last year, especially during 2020, we had less lease up rate. It was just our turnover wasn't very high because we had no cases of COVID, at least in the Hampton Manors facilities that we cooperate with Shaheed. COVID has definitely had an impact on the senior population. There's a very abundant senior population, however, and because of sort of the economics of Hampton Manors in general, it doesn't need much to create really strong cash flow. The second really big impact that COVID has had is on the labor force. There's a lot of people who got a lot of unemployment checks last year and the year before, and it was very hard to get labor. So this is something we worked with Shaheed to find labor sources. We had to up our labor costs from around $12 an hour to around $16 to $17 an hour in rural Michigan. So that was something to make sure we attract very strong talent for our care, as we don't really necessarily need licensed care or nurses, although we do have typically one RN on staff. So I want to highlight the 3 investment opportunities, and it's a little bit just math, right? It's you have our income shares, which we've done before, and we're paying monthly. And if you invest $100,000 in this income share, you receive 1% a month. It's a very easy math. Whatever amount you invest, you get 1% a month, and it's a fixed return for 3 years, and then your capital back at the end of 3 years. And this 1% a month will start next month in May. So a very attractive opportunity with very little cash drag for the investment.
And how do you expect, a question has arisen, how do you expect return of capital within 36 months?
Yeah, so the project essentially going to be recapitalized through either refinance, recapitalizing our investors through redemption, or a repurchase through additional investment vehicles. Typically ourselves, as that's sort of the arrangement that I have with Shaheed. I want first rights of buying any facility, any community he has. And so you'll be seeing a lot more Hampton Manor senior living communities being offered to investors over the next 3 years, as they provide very strong cash flow for Shaheed. And if you think about it, he has a lot of communities under management, a lot of them paying a lot of money, and he wants to build as much as possible because he's got this figured out. And the reason why you probably don't see that many senior living communities offered in these type of syndications is because they're owned by WellPoint and big, multi-billion-dollar institutional companies. This is a really strong investment vehicle, really finding a really talented operator and developer, Shaheed, who is going to be massively growing over the next 5 years. My plan is to help him grow to 100 communities over the next 5 years.
And we have 2 questions. Is it okay if we ask them now?
Yeah, sure.
Yeah, sure. So the first one, we've talked a lot about the predictability of this investment. Can you answer, is the 1% per month cash flow guaranteed?
No investment is ever guaranteed, but to the extent that I feel very confident, like our PEC and this one, we are paying this regardless of what typically happens. So we've never missed a payment for any of these pref equity investments, and we have had a significant amount of them. Now, in some of our profit sharing investments, which this is not, we definitely want to make sure that we provide actual profit returns, and sometimes that is more variable both on the upside and the downside, depending on the market and operations and any local incidents that might happen.
Great. Another investor asks, is this distribution a qualified dividend? Explain the tax benefits.
This distribution is a ordinary business income distribution, so it's a passive rental income distribution. So you get K1, you get typical depreciation, although that's not necessarily the focus in this one because of the growth portion of the shares. We're not going to have any bonus depreciation until we actually open it, and then we'll incorporate that into the fund for investors. So I'm going to go through these 3 slides, so just bear with me. So very simple, 1% a month. We've had many of these investment vehicles with our data center fund, which we successfully we were paying this month. And for our senior living investments, both our 10 exchange investments and our senior living investment vehicle that we offered last year. What's new in this investment vehicle is a blended share, which combines our growth offerings and our income offerings, and providing sort of the best of both worlds, which is monthly income, very predictable fixed monthly income of 0.667%, or essentially 8 divided by 12, paid monthly to investors starting next month as well, and then a 20% fixed return at the end of 3 years. And so this will be a fixed return, sort of just a coupon with very strong returns at essentially 44% total returns in 3 years. And then finally, our growth option, which is we've had 4 of these growth investments last year, very, very popular and successful investments. And one of them we're actually almost finished within, I think it's only been like 14 months since we started construction on that one. And so we're typically for our construction projects, it does take 16 to 18 months to construct. Although we started constructing on this one earlier this year, so we're ahead of the game. So for the growth investment terms, it'll be a simple 50% return at the end of 3 years. So very typical return, very similar to our previous growth investment offerings. I want to spend some time on this slide and really highlight sort of what pref equity means to me. It means that if the investment falls down by 10%, whether through just market conditions, the pref equity, our investment, is still in a relatively safe position. This phase 1 is raising $6 million to place $4 million into the cash flow position and $2 million into the growth position. And so it'd be a dual tranche equity structure where Shahid will be placing his $6 million of equity above that, and he gets paid last because and he's betting on himself, which I really liked. So it's a mix of really strong returns, very equity-like returns, fixed predictable returns, but the relative safety on the capital stack. And so in this case, like if the investment only returns 5% a year, you still be able to pay all the investment returns to investors because of how relatively safe on the capital stack it is, because the sponsor equity essentially gets nothing in that case. So if you have the same amount, you essentially be paying 10%, able to pay 10% to the pref equity position. But in this case, he's really combining all his other investments into and making sure that he pays on time. And we have this will be our 12th Hampton Manors investment with him. So and we're actually doing a lot of his accounting. So I have a very strong sense of his finances. Thank you, Kathy, for that. We should really charge him for that.
And a question that I think is pretty germane to this slide: how much of Tozi and Tozi's partners' own money is going into this project?
Well, so Tozi and so there's 2 questions, or just
It's how much of Tozi's partners' own money is going into the project.
I see. Yes. So in this case, I already placed $1 million for St. Peter's to get that project started last month. I just haven't even got around to putting this deck together because working very much on Bitcoin mining. For those who don't know, we also have Bitcoin mining. So and likely we'll have close to 10 to 15% of the capital in this fund. I also like to provide an inventory capital, allowing investors to come in if they so choose. Although we will be closing the investment for this $6 million phase one in April, likely next week. And the way that I see our exit strategy is we're going to likely sell St. Peter's to a income fund that we will have, likely this fund. Is just be a kind of separate title. We'll have separate LLCs to change the title to really provide sort of a very fixed return. The goal for Shahid is within 10 years to have 100 or really 5 years to have 100 of these properties, and then to sell to a major REIT at a very compressed cap rate. At that point, he'll be a very rich man, but we'll make a lot of money throughout that process. But he's betting on himself on the exit. And this is something that we've done a lot. We've tendered on exchange our own investors, my parents' money, my money, as we've tendered on exchange a couple of our assets within each fund. And we try to make sure that we have very tax favorable exits, allowing us to continue to compound and defer taxes to the future. And actually, we have helped Ryan has helped a few tender exchange investors into our previous funds. So if you ask me why is it 11 and 12 and you haven't seen many, because those been kind of secret deals. As anyone who has wanted tender exchange investments into some of our income producing properties, offering 12% returns, Ryan and Shahid has helped them out.
And you mentioned on that last slide that there's going to be a 1031 at the end. An investor asks, can I 1031 that return of capital into another similar asset class if available?
Potentially, it depends on your investment amount. Essentially, the way that we would typically handle external investors who want to exchange separately, we would have to drop that partnership out before we exit the fund, because the fund itself will tender exchange into the next property. So if you stay within the fund, you'll just have a bigger capital basis into the next thing, if depending on which share you want. If you want the growth share, essentially have 50% more capital basis in the next fund, then you can transition to an income share and get 12% on a 50% higher investment basis. But that's for tender exchanges independently to your own property. We will likely determine if there's enough interest. We can do a drop and swap. I think I have a YouTube video on tender exchanges on that. I'm pretty sure I do. I'm gonna switch gears a little bit and highlight commerce on a video. If you can see my screen.
I can see it.
And I'm going to optimize for video. This is commerce. And Ryan, you've seen many of these communities now. You visit with me.
Yeah.
This looks very familiar, right? Very similar.
It all looks very familiar.
Yeah.
And Shahid's got the tour down pat, showing you knobs, why he picked out this material, and it's all very purposeful.
And one of the things that struck me when I first visited these communities is, where's the doors? And I realized that you really need doors when you're a senior. Sometimes not. So it's interesting. All the showers are very senior compliant and very friendly for our elders.
And I love how nice these assisted living communities are. They're very clearly A-class communities, places that I would love to stay in. I was showing my wife a picture the other day, and she was like, "We just move in there."
Yeah. So Commerce is currently around 45 to 50% occupied. It's currently staffing up. It was built 8 months ago. It was opened 8 months ago, and so we expect to be fully leased up by the end of the year. And like all of our communities, we have a spa, a hairdresser, a cinema, and it's one of those things where you do see a lot of use out of these rooms. I was always happy to see, our seniors, our residents book time, and they have their own little just hair appointments. You have family gatherings almost every day, and when COVID was at its peak, we had glass walls to separate the residents from the outside world, so that we can have a very clean facility. So that was a sneak peek of Hampton Manors Commerce before it and before called Commerce Comfort Care, because of the previous partner, though we are rebranding it to Hampton Manors, even though he built it. So he was sort of living in a time where what they call what it was. And sort of these are interior views of Hampton Manors, very similar to our previous Hampton Manors communities. And we will be uploading a Q&A, FAQ video with me and Shahid as we talk about his properties and his history with senior living communities. So the next, the other project is St. Peter's in Missouri. And we launched our Missouri Growth Fund late last year, and we were able to get construction up going on Wentzville and O'Fallon. And initially, the plan was to have the other construction project in the Missouri Growth Fund, but in this case, we wanted to incorporate it into this to really have those different share options. And I want to highlight a quick drone footage of the community. You can see this was taken last month, and you can see we've really broken ground. So typically with our communities, the way that typically with our construction projects, the way that the timelines work is that we want to get permitting, we want to get the land purchased, and we want to get everything before, and it might take 4 to 8 months to get all that prepped up. What I like about this project is that we already broken ground. We got the permits, we got everything going. So it's kind of full steam ahead. We're just incorporating into this fund to provide investors that nice exit return for investors. That's a little abrupt. You can see that it's across a very residential community in St. Peter's, Rouse Slide, St. Louis. I can share that with you.
Sorry.
Okay. So that's St. Peter's, and of course, St. Peter's would be very similar to other ones in Hampton Manors. And Tozy and Hampton have had a very strong partnership. We've done a few 1031 exchanges. We highlighted our Hamburg property, which is an income producing property. We're providing 1% returns starting last year. And our Adrian, which we closed recently, right?
We closed last week.
Yes, we helped. How many investors close that one?
A total of 7 different investors.
1031 exchange investors. We created a tick into the Adrian investment. And then we had Dundee was also 7 1031 exchange investors, including my parents. And then we have our Opportunity Zone project in Jacksonville, which is broken ground and going full steam ahead, and Waynesboro, which is currently starting to get in that process as well. And then we have our Missouri Growth Fund, which is, we talk about the Wentzville and O'Fallon projects. Essentially, this is a trio of projects, including St. Peter's, which will be in this fund, and then our Hampton Manors Merritt Island project, and has partnership in Venice as well, which is full steam ahead. Will likely be opening up in the next few months for that project. So well ahead of schedule.
And then we have a couple 1031 questions on the page. Will this fund accept 1031 exchange money?
Yeah, potentially. But actually, no. So we're closing on the project that we're not closing. We're closing the project next week. Tozy Capital will likely provide a lot of the inventory capital to close on the project. And then we will have investors fund up until the end of the month, although likely we'd like to get all funding done next week. Typically, 1031 exchanges take a lot longer time. Ryan, you're very familiar with the process. How long does it usually take? How much advance notice do we need for those things?
So I've gotten them done in 2 months before, and in some cases much longer than that. And I'm working on closing Hampton Manor Woodhaven right now, which is going to take only about a month. So it varies from project to project. There's a lot of moving parts depending on a lot of different things. But to any investor that would like to 1031 exchange into one of these Hampton Manor deals, please reach out to me, Ryan@tozycapital.com. I'll put my email address in the chat box. I'm happy to help you, walk you through the process and show you how this all works.
Yeah, Ryan's almost an expert now at these ticks. It's very complicated, but typically there's a lot of coordination with everyone and timing. So it does take a lot of advanced planning. Let us know as soon as you can, and we'll try to fit you into our future projects. But for this one, because of a tight timeline, St. Peter is essentially ready, capitalized by Tozy Capital, and Commerce closing, sort of the bank closing next week, essentially the transfer ownership end of next week and the 22nd, and we'll likely recapitalize most of it, although investors will capitalize some of it. We already have close to 25% of it pre-committed, and expect probably fully committed by next week. I want to highlight our the entire portfolio with Shahid. A lot of them are our investments. Some of them are 1031 exchange investments. But a lot of really great projects across America, mostly in Michigan, Florida, and some in Virginia. And we will be starting some projects in Texas in the future, and then also in Missouri. So to highlight the timeline, we've begun the construction in St. Peter's last month. In fact, Tozy Capital already invested in that. We put initial capital into it, and we will be closing our Commerce property on April 22nd. So hopefully we get funding before then, but we're also in the position to help pre-fund a significant amount of that, though we will likely close this fund, and we will close this fund at the end of April. And then first distributions for investors, this will start end of May, and we'll have regular payments at the end of every month. And then recapitalize to investors at 3 years after that. And I want to highlight also that these Hampton Manor properties are 100% private pay, which allows us to really have sort of better control of our finances, who gets paid and how we get paid, and really have less regulatory headaches when it comes to accepting Medicare and Medicaid payments. This also means that our residents typically are pre-checked financially, as I mentioned earlier, to make sure they have all 3 years of payments although some do extend beyond 3 years, depending on how long they stay with us. Superior is very similar, 92 units, very mid-market pricing for the area. So it's not very premium pricing. If you know about senior living communities, you see pricing as high as 10,000 or above a month. That's not where we're located in the market. We're not also, nursing homes. We're not sort of the cheapest option, but we're sort of somewhere in the mid-market, sort of the low mid-market for our community, and all Class A kind of newly built properties. So floor plans, studio, memory care, 1 bedroom, 2 bedroom, and a lot of the 2 bedrooms are filled with couples or friends. As you typically, we have a bigger percentage of female residents. And we have a full range of services, and that's sort of the biggest expense with any of these senior living communities are staff and labor, and they provide really strong services, and 24-hour home, 24-hour care, where we provide either in-room dining, or we'll bring them to activities room and have bingo and community dining for our residents. And of course, I mentioned home, movie theater, hair salon, which you can book an appointment, and game room, library, and a nurse's office and activity room as well. So with that, just to summarize, this is our 11th and 12th investment in senior living. Very strong track record with Shahid. It's a pref equity investment, so fixed returns and relatively safety in the capital stack. And we will be as tax favorable as possible. So I'm a big investor into this one, and I would likely want to make sure I have a very tax favorable strategy for myself, which everyone will share along with. So I'm gonna start there, and then let's get to questions.
Yeah, let's do it. So this is a poignant group of questions because you were just talking about the tax side of things. So let's tackle a few tax questions here. An investor asks, any state income to be paid on the dividends?
And no.
Short and sweet. Okay.
Well, sorry. There's no specific state income for Missouri and Michigan. It's more state income for your investments because you're a passive investor. So we're not paying state income taxes there.
Gotcha. An investor asks, okay, so 8% of the income to investors is passive. This is on the blended one. Is the end payout also considered passive or capital gains?
It would be considered capital gains.
Okay. Another investor asks, hi guys, will each of these funds have different depreciation the first year, or is it all one fund?
It's all one fund. I'm not, in this case, we're not necessarily emphasizing bonus depreciation. And this year will be sort of, I believe the last year we'll have full 100% bonus depreciation. Next year will be set down to 80%, and then 60%, I believe, the following year. So over time, bonus depreciation will be less of a factor. And because one of our properties will be a new construction, you don't typically do a cost segregation study until you're in operational state, which will likely be next year. So we will have bigger depreciation amounts as we incorporate more investments into the vehicle for investors.
Great. Okay, a couple growth fund side questions. An investor asks, is the growth fund capped at an equity multiple of 1.5? Is there any bonus if exits exceeds expectation?
Yeah, the bonus is to Shahid. That's the honest answer. Like, I would love to have a profit sharing with him, but I actually don't mind this as well, because I know what we're gonna get. We're gonna get a very fixed, predictable return, and we're gonna get it first before he does. And so he put in money enough that if we sell at a loss, we still get the returns. We will still get the returns. That I don't know why he would sell at a loss, because some of these projects like Merritt Island, he's gonna be making a lot of money. Good for him. I want him to make a lot of money. I want him to pay us a lot of money. I want him to be very liquid and have a lot of cash flow. And I want our investors to have very predictable returns. So I think everybody wins here. It's not a project where you will get a profit share component. And I do believe that Shahid will likely make a lot of money from these projects. And then you might ask, like, why don't he get more debt? Yeah, good question. I don't want him to get more debt. I want us to get paid a lot of money. He definitely asked me to look into making a bank and other stuff. Right, you were there in those conversations. He wants to keep a cheaper source of capital. I think we are a very predictable source of capital, and we want to get as much returns for our investors as possible.
Great. We have a couple questions about the risks of this.
Mm-hmm.
So the first question an investor asks, in terms of the risk to the investor, i.e. likelihood that we do not receive the quoted returns, do you think PEC or senior living is more risky? Is income or growth option more risky?
I think the first question is PEC, which is our a very predictable as well, 10% or 14% note. I like to really highlight PEC as sort of an investment for first-time investors because I know for sure we're going to pay it. The cash flow, I have very strong control of the cash flow for that investment, and essentially we're prioritizing the investors first. When you think about a typical syndication deal, you have a 2 to 3% acquisition fee. That means that the project needs to make a lot more money just to cover that sort of smaller pie of returns as that pie gets sliced here and there from these fees, which are very warranted for the sponsors. And we are going to partake in some of those in the future investments in real estate. And in this case, there won't be any fees. There won't be any property management fees. That's the big thing. If we have a property management in Grand Royale where we own it, and we've paid 5% of our gross revenues. In this case, Shahid's a property manager. He's not getting paid before the investors, even on the property management fee. So there's 0% property management fees, 0% acquisition fees. So in terms of the income and growth shares, the risk, so I essentially think it is a pari passu, but yes, if you think about it, income shares, you're essentially getting paid in the event of financial calamity, collapse, death of the key players. Technically, probably the growth would be likely more at risk, although because of the capital stack, you essentially secure against an asset that has significant value and will likely have more value as we lease up and we construct and build these projects over time. Most of these construction projects are typically cost around $9 to $10 million to build, and we can sell them easily without even leasing it up at all for around $15 to $16 million. I would love to be an equity partner there, but I am only a preferred equity partner. And that's okay. A very predictable returns, great returns, and no stress for us.
Another question on the risks. An investor asks, in what situation I will not be paid my dividend or capital back on the growth fund?
In the situation that, even in the situation where something happens to me or Shahid, you will essentially be a co-titled owner of the property, and you will essentially be on the existing equity, and we'll have definitely a line of succession sheet sets that up. And in the case that we sell or something, you have an early exit, these properties already have baked in equity. Essentially, you're taking Shahid's equity in that case because you have priority.
Great. Another question on the risks. What's the break-even point for these facilities to stay on track?
So that's a good question. And I think the answer is really because of the capital stack, we really only need to have around a 4 to 5% return on capital to pay the private equity investors. And when I'm a bank, if I was a banker and think about lending debt to the capital, we're lending debt capital at around high 3s, low 4% interest rate. And we lend that because we're relatively safe on the capital stack. We know we can get paid as debt. And so the break-even percentage for most of these investments is really around 50% occupancy. But it doesn't matter if we're at 20% occupancy or 100% occupancy. We're getting paid regardless. And that has been the track record with Shahid for the last 10 years for all the investors, and for us in the last 3 years for our investments with Hampton Manors and Build Senior Living.
So an investor asked, where will the cash flow come from in early years?
We'll definitely get cash flow from the project as it is right now. Shahid runs very light. He shares a lot of the same expenses across other properties. When a project is leasing up and ramping up, there's very little expenses burdened by the specific property. We're not leasing up full capacity because other properties already have those type of labor, and we rotate labor and expertise. And so we have a very strong executive director that helps build up these communities and staff up. So our expense just generally are very light. It's one of the scrappiest in type of investments I've seen.
There's 2 questions where investors would like to see the slide deck. Can you pull the slide deck back up again?
Okay.
So the first question is on the capital stack page. And while you're getting there, I'll read that. Can you show the capital stack and water flow in a diagram, please? I'm hearing top is debt/mortgage. Second is the 8% or the cash flow to investors. Third, Shahid is paid last.
Yeah. Yeah. So if you think about it, you take a 70% LTV for your loan, right? And if your house goes down by 10%, you lost 33% of your equity because you have 30% and now it's 20% over the, whatever that number is. And the bank still is fully well off. So the project would need to lose that significant amount of the top portion of sponsor equity, Shahid's equity, to have sort of a risk. But you can't think of it as just these 2 projects because he thinks of it as sort of his whole stack of diversified Hampton Manors portfolio, which is 29 projects altogether. So it's a very big portfolio of diversified portfolio. You're getting diversified risk, although ostensibly you are a co-title owner in these 2 communities, 2 facilities. So really strong preference, and that's why I felt very confident about these for investors.
Thank you. And the next question is, can you go to one of the slides with the average room rates? An investor asks, average cost for a room at Commerce or other Hampton Manor facilities.
So these are average costs around $4,000 to $5,000, and these are the same pricing that we have in all of our other Michigan communities and these rural townships. These townships that have only a couple of tens of thousands of people in the local little area, but that's enough for these communities because these are aging communities. And we do have the feasibility market study analysis for both communities in our offering room right now. You feel free to look at that, look at how the pricing compares to our competitors, which is very favorable pricing compared to other competitors that are dated, older, doesn't have as much amenities. So we come in at a very scrappy, very great rate that allows us to quickly ramp up and get occupancy very fast.
And speaking of that occupancy, what's the current occupancy at the Commerce property?
It's around 45% as of today.
Great, thank you. And then another request to share a slide. Can you share the blended growth and income options again?
Mm-hmm.
And while you're going, it's kind of interesting how we came up with this blended option. You and I were texting kind of late. What was that, a Friday night? Just trying to figure out how to find some returns that provide stable cash flow with a nice exit. And so here we go.
Yeah, so I like to really take investor feedback and, feel free to give us feedback as much as you can. I talked to Ryan a lot about, how investors react to these investments. We had an income, senior living income fund last year. My camera might die soon. 1 second.
I mean, that's a good picture. Who took that?
Look, I'm gonna make my other camera. It's a different camera. I have to raise of a Plan B camera. Okay, so look very weird in the presentation. And so the income is really a combination of a lot of our previous investments. Our growth is very similar to other ones, our growth investments in our Venice, Merritt Island investments. And blended is really just a combination of the two to provide a mixed return of strong income. 8% is better than almost any other real estate investment, and it pays next month. There's no waiting for quarter payments or the next quarter or 6 months from now. And I talk about my own investments too. So I'm familiar with how our investments are, and we will have those investments in the future as well, potentially very soon, as we're under LOI soon on a couple of projects. So these investments allow us to provide the mix that we want to provide for people who have a preference for high cash flow, very strong cash flow. 12% is very strong as economy, especially secured with real estate. And then 50%, a very strong predictable return within 3 short years. And then blended, providing you 8% returns every year, paid monthly starting next month, and 20% fixed capital return addition to your 8% for the last year. So 144% returns in total.
Great. That's the last of the screen sharing questions. Okay. There you are. Okay, an investor asks, are you Shahid's exclusive capital partner for all his projects?
No, I don't think I am the exclusive capital partner. I think I am a capital partner for probably 80% of his projects. And going forward, we would likely to be more than that.
Great. A couple questions about depreciation. Is the depreciation expected to fully offset taxes on the passive income?
Typically, yeah. Yeah.
A couple questions about interest rates here. Is this the right time to invest in real estate as Fed rates hiked, and not to mention recession may be coming?
I would definitely see a recession coming. Depending on you have the inverted yield curve, you have strong headwinds, macroeconomic headwinds with inflation, and probably the Fed, putting 50 points on top of interest rates. And that's going to have an impact on purchasing power. Now, the purchasing power for a residential purchaser versus a commercial purchaser is completely different. And the capital stack that we're providing here, the interest rates of 4% versus a 4.5% or 5% rate is still very favorable for an operator, income producing property like Shahid, right? This is essentially investing in a business. The business prints a lot of cash, and essentially we're investing in cash flowing businesses. And so it's similar to our Bitcoin mining. If I was investing in Bitcoin mining and financing that, the interest rates are 12 to 17%. And hundreds of millions of dollars are borrowed at that rate because of how much cash that investment prints or that creates. And so similarly for senior living, especially Shahid's senior living investments, he makes a lot of cash flow. So I think it's not saying it won't have impact overall on real estate in general, but because of the structure of these investments, I feel very confident about this.
And another question on interest rates, is the pro forma considering the increasing interest rates?
Yes. So he's committing to the returns, and I work with him on the financials, and in some cases I can show the bank accounts, so I know exactly what's coming in and out. We have very good room to spare, and he's not paying himself. And I know that because first of all, he just had a baby this morning, and he's living in Michigan where he has 19 properties, managing Michigan.
So you mentioned you have a line of sight into what's going on with his accounting. An investor asks, have you done a financial audit of Shahid's assets and overall cash flows?
Yes, I have.
Great. Another Shahid question. What was Shahid's worst project? What went wrong?
I think any of his projects that have been wrong has been mostly partner related. And that's why he likes partnering with us, because we sort of give him as much control as possible on operations, because I like giving people full domain of where they are best, right? I'm not a senior living operator. I'm not specialized in that, even though I have a lot more senior living. I could probably do it myself, but it's not something that we are trying to specify. We're trying to partner with strong operators, and the projects that Shahid hasn't done well and has been the ones where he had to buy out a partner and then take over control. And that's why he's partnering with us on most of these things. He hasn't had a negative exit at all. He hasn't had anything that turned around in terms of not paying the banks or not paying any, and so that track record hasn't been broken at all.
Great. So more Shahid questions here. Is he guaranteeing dividends and capital on his own credit or other centers? Or are the separate LLCs that can be bankrupt separately?
Essentially, it should likely be sort of isolated each other. But the way that I know he works is that it's sort of guaranteeing it across all his portfolio and his cash flow, and he has significant cash flow.
Great. So how many projects is Shahid doing currently? How is he planning to scale to this additional project?
So he has 6 constructions going, all of them with us, and we're likely gonna acquire 3 or build 3 or 4 more every quarter with him. In some cases, there'll be tendering exchanges. Some cases there'll be repurchasing partners that he's sort of outgrown and trying and build a bigger cohesive brand. In some cases, there will be new construction as he's identified new markets to then build a trio of Hampton Manor projects.
An investor asks, is Shahid cross-collateralizing his properties so that the cash flow shortages in one property is covered by a property with excess cash flows?
Yes, essentially.
Great. A couple questions on the structure of these deals. An investor asks, do any of your options have profit sharing?
Not with Shahid, and I've asked him to do so. Unfortunately, he won't give me any profit. That's okay. Everyone has their own thing. And I like that it's pref equity in this case because this is relatively safe.
Great. An investor asks, will there be bonus shares for higher level participation? Example, an extra 5% for a $250,000 or more investment in the Missouri Growth Fund.
We don't believe so, but ask me when I have a few drinks.
Will we be doing more senior living funds this year? That's actually a question from me. No, it's from Leo.
Well, we will have a lot more senior living funds this year. I expect at least another 6 to 8. And then we're evaluating a couple of projects in the Dallas area. And last year we were talking about looking into Oregon, opening around 10 centers in the next 12 months. The challenges has been understanding each state's specific permitting and licensing requirements as we're trying to try to scale up. In Michigan, we really kind of have a lot of projects, and we're actually going to build probably 6 more over the next 12 months. We're waiting for permitting. We usually pre-buy the land, and then we get investors to help with the construction flow, although we do get the construction loans in advance so that we can start construction operations.
Here's a good question. Do we have special stay benefits if we visit the senior living? I like that one.
I'm happy to get you guys special stay benefits. We've actually had lots of investors come with us, a few investors come with us to Hampton Manors. And if you want to visit, and we don't have to go with you guys because we're in California, but we do love to do that. So oftentimes when we're visiting Michigan and Shahid's hometown, he has great Pakistani food, amazing cook. It's so insane how much food he always has. We do like to show our investors the community and how much Shahid really cares for the seniors and knows all the staff. It's incredible. He knows the names of every staff. He actually does interviews himself. I'm not sure how he does any of it. He probably has the same questions for me, or you guys do as well. I feel like we're kindred spirits in that sense. We're both hustlers. He grew up out in the outskirts of Lahore. I have an FAQ with him in a small remote village. We were trying to pour ourselves. He talked about eating banana peels when I was a kid. He talked about tasting chickens. Ryan talked about playing on words.
All right. While we were there, you guys were acting like you were brothers and hugging, and I was just standing there awkwardly next to you. It was the third wheel the whole time. That's fine.
That's good.
All right. So moving on, are you targeting similar returns in terms for the upcoming camera just senior living projects? Are you targeting similar returns in terms for the upcoming senior living projects?
Yes, so we'll likely have a very similar return structure. Senior living projects likely going forward will be incorporated in this fund, giving a little bit more diversification of cash flow, although essentially it's really Hampton Manors portfolio altogether. And so these three type of structures would be likely the ones we go forward with. Although we're always open to feedback from investors within reason.
Here's a good one. How is this investment compared to Bitcoin mining investments?
Yeah, Bitcoin mining is a very strong investment if you believe in the future of Bitcoin. And not everybody does. I am very long-term bullish in it, but I also ultimately am an investor. Why do I have real estate investments, multifamily, senior living, debt, consumer debt investments? We even had SpaceX a few years ago. And we have Bitcoin mining and data centers, and we'll have more of those in the future. Looking forward to presenting those projects that we're working on. Ultimately, I'm just an investor. I like to invest money and make a lot of money. And I like to do it at scale because that's where you get really strong economics. And I started Tozi Capital to provide investors sort of the same type of returns that I've been getting for the last 12 years of my real estate investing journey. And I think that, if you compare it to Bitcoin mining, it's definitely a more speculative investment. I like it. I think it has a lot more upside. This has a fixed return, very predictable, secured against a hard asset, secured against land, deed of title, construction project, and materials. All things that are going up in inflation price going forward. So I'm looking forward to both projects. It's hard for me to gauge the risk reward of each one because I'm so bullish on all of them. Although if someone asks me what's riskier, definitely Bitcoin mining is riskier, but it has higher potential upside.
All right, now we have a couple Opportunity Zone questions. One, is the Opportunity Zone fund still open? And two, are any Opportunity Zone projects coming up?
So it is not still open, although connect with us if you're asking for something. We're working on potentially helping some people out. But the Opportunity Zone project, Opportunity Zones in this year, investing this year, you're not really getting that 10% reduction. You are getting the capital gains deferral for till the end of 2026, so December 31st, 2026, getting that reduction or the deferral of taxes, and you pay it then. So it's just a 5-year deferral, or really 4.5-year deferral at this point. Still pretty good. Deferrals great. You not pay taxes now. Capital gains, especially in California, very high. Although California does not recognize Opportunity Zones for it's a non-compliant state. Though we do have lots of other investment vehicles that do help with taxes. We'll be presenting one in 2 weeks, I believe. Yes. Man, my schedule is packed. But it does have a really great 10-year exit horizon in terms of no capital gains in the future. But we believe that 10 years potentially is sometimes long for a lot of people. So I don't think we'll be actively pursuing Opportunity Zones in the near future.
Great. An investor asks, can you talk a bit more about how depreciation works in this investment? Suppose I invest $100,000 in the income fund. I think I heard you say that depreciation would cover my $1,000 monthly cash flow, and then the return of capital after 36 months would incur capital gains, but those could be 1031 exchanged.
Yeah, so the fund will actually invest in 2 vehicles, both properties, and they will receive K1s from both vehicles. And then that K1 will be combined and given to the investors. We'll add additional tax treatment to make it more favorable for investors. but you essentially be a mix of the depreciation that comes from the income producing project and the growth project. So you can actually invest in the growth shares and get the same K1 treatment as income shares. So likely there won't be too much of a negative sort of a heightened favorable benefit for income shares, but my estimation is that it will offset all income produced by the shares itself.
An investor asks, are you worried about oversupply coming from other similar senior living construction projects in the area? Does Shahid expect the 45% occupancy rate to go higher?
Yes, he does, because it was built 8 months ago. And for projects that have been going on for 12 months, we're typically around 70% occupancy, and 18 months, we're around 90%. But he runs very light and he makes a lot of cash flow from these investments. So I can vouch for the fact that, you know, he doesn't need much to get going on these. I would be worried about oversupply in certain hot markets. I don't think there's a lot of people building in Michigan or Missouri. And I think that these projects are sort of his niche in these rural townships where there's tens of thousands of communities, homes, and families that are in desperate need of these type of really nice, refined, luxurious communities at these very favorable price points.
An investor asks, what should we need to know before visiting on site in Michigan or Missouri?
Well, let us know so we can coordinate with you. We can help you get on a tour, or just surprise visit. Call them, ask, you know, hey, my mom or grandma is, you know, happy to have a surprise visit as well. Let us know how that goes. But if we can, we'll love to show you around. We'll show you around all the phases of construction. The last time we had a investor tour in Q4 last year, we went to Michigan and we visited 5 communities. One that was in a, you know, fairly much fully occupied state. One was sort of in a leasing up state, just open. And so we had half the wings of that community closed so that it was more full in the other half. And then the other ones were just opening in a few weeks or under construction. And so it's always nice to see the whole gamut of the life cycle of construction to lease up and to fully lived in.
Here's a good question. I always like hearing you explain this. For a new investor, can you please explain what preferred equity refers to?
So there's preferred equity and preferred returns. I think those two things can be confused. Preferred returns mean that you as an investor are getting returns before anybody else. Preferred equity is somewhat similar, except that it's sort of given as sort of a fixed number return, and very similar to some other multifamily deals where you have Class A shares, Class B shares. The Class A shares is a 10% fixed, and it's not pari passu, which means that if only constitute 25% of the returns or the capital stack, then if it pays out 10%, which actually is usually around 8 to 9%, the whole project only needs to provide 2.5% returns because it only sits in a quarter of the capital stack. Sounds like a lot of math, but essentially it's a very favorable sort of capital stack where you're essentially treated like debt, right? You're not going to not pay your mortgage. Doesn't matter if you've been laid off, you kind of still pay your mortgage. And so it's one of those things where it depends on how much capital is above your stack is how safe you are. So in this case, we're essentially less than 80% LTV for this whole capital stack. So you're essentially being treated like debt. And as most commercial real estate, most senior living gets 80% LTV on senior debt by itself. So we're actually getting a lot less, and we're sitting below that 80% line.
A couple 1031 questions here. Can we 1031 from an investment property across multiple TOSI vehicles?
What is that?
So I think what the investor is trying to ask is, can we invest 1031 exchanges into multiple different TOSI investments? And historically, we've only been able to accommodate 1031 exchanges into these Hampton Manor income fund type of deals that pay 1% a month.
Yeah. Well, if you have 1031 exchanges that you're planning, let us know. We have a pipeline of investment vehicles. Sometimes we only do it for tender change because we only need a couple of $1 million for that project, and we fill it up pretty quickly, providing double-digit returns, right? Way better than most DSTs or other tender exchanges, all kind of fixed returns, monthly payments. And I think typically we have projects for almost every dollar amount. I know Chester is asking about what dollar size tender exchange can handle. At too small of a level, it kind of doesn't make sense to go through the whole process, right? You're getting paid for QI, qualified intermediary. One day there'll be smart contracts and NFTs for this. I'm working on it. Not this year. Just stop doing new things. And we have a lot of new things. I think around 50,000 is probably too little to have. I think what's the smallest dollar amount we've actually accommodated?
I just finished a $50,000 one.
Okay, all right.
In that case,
we're very accommodating, yes.
In that case, it was a gentleman who had a larger property that he was exchanging and had some leftover funds. And just like I was happy to be your plan C tonight, I was happy to be his plan B for a 1031.
Ryan Betty, everyone's plan fail safe.
Yeah. Took me a while to find my wife. So an investor asks, why are we not paying Michigan and Missouri taxes? Is it structured as a REIT?
Not structured as a REIT. The tax, sorry, the income essentially post all that. So you're essentially paying that on it. You're not necessarily going to get paid. You're not paying those taxes on the state income. But I will, because you're questioning my CPA related question, I am now going to ask the CPA for that. We'll get back to you.
We'll get back to you on that. All right, we've got a couple growth fund questions. Can you talk about previous growth fund investment success stories?
So we haven't exited a growth fund yet, but in Merritt Island, we're actually full steam ahead on that. And we're likely going to open it in the next few months. Shahid has an offer on that project already, and he might exit early on that project. And he told me about that offer. So he's looking forward to potentially paying it.
Is it safe to say Shahid has relationships with these people who are looking to buy these properties? Is he typically selling to the same?
Yeah, so he produces very good product. So I would love to buy all of his projects, but he essentially, the way that our relation works is that it's pref equity. So he knows how much capital payments we pay out. Sometimes he wants capital to build more, so he might get a better offer. And so for Merritt Island, I believe he'll probably sell it, not to us, unfortunately.
An investor states, for what it's worth, I have an investment in Michigan and I have to file Michigan taxes.
Here you go. I'm not a CPA.
And then the last investor asks, did you say Venice as in Florida?
Yes, we have a project in Venice, in Florida. And we have a project in soon to be Naples and a couple in maybe Sarasota soon. So these are all projects in the West Florida that very interesting projects and stuff.
This concludes the Q&A portion of tonight. Oh, so we got one more. What happens at 36 months if there is no exit or refinance?
So for essentially, we'll continue the payment scheme, and we'll just essentially increase that return on a pro rata basis of timing, very similar to our growth funds. But based on my past experience with with Shahid, he pretty much pays it. He has capital in his accounts, and he has likely buyers. So we plan well ahead of 36 months. In fact, sometimes he sells before that and puts me in a bind because I don't necessarily want to exit before 36 months.
Well, now we have no, you guys are faking me out here. Florida has no state taxes and California will tax you on every breath you take.
Yeah, I should really stop just being so assertive with my CPA questions. I am not a licensed CPA, but maybe we'll hire one next time to test it. I don't like to evade these questions. Any more questions?
Going once, going twice. That's it.
Thanks everybody for attending tonight's presentation of our Senior Living Blended Fund. The deal room is open now. We don't have subscription docs ready. We will likely have it this weekend, and we will announce that. This recording will also be available. The deck is available now, and then the feasibility studies will be available the deck will be ready available tonight. Thanks everybody. Thanks Ryan for moderating and being my plan B if C option.
It's too late. Oh, Q&A.
Yeah.
Thanks for answering all the questions. Thank you for asking all the questions, Chester.
Thanks guys. I appreciate it. Have a good night.
Bye everyone.